This is the market and economic report for the week ending July 4th, 2022, and beginning the trading week of July 5th, 2022. And this in this report, I really haven't changed that much from a personal sentiment standpoint, which basically remains pretty close. I've made a small adjustment, but my short-term sentiment is that I'm 60% bullish, 40% bearish, 0% neutral. So this impacts the way that I trade, what I'm thinking about. Doesn't mean I'm all bullish. Some people have asked me about that on some stocks or underlines that are out there. I'm playing kind of both sides of the fence, if you will, with a small move a little bit more towards bullish sentiment. Now, it doesn't always work out the way that you like, but playing almost 50-50 on my trades and the way that I invest is probably the smart play. Midterm, I am 55% bullish, 45% bearish, 0% neutral. I think we're starting to see one of two things that's going to happen. And again, I'll give my theory here at the end of this episode. But I slowly moving towards the more bearish component as I move forward, especially as I look at some of the things that are happening. But I'm still of a belief that we very well could see either a bear market rally that just goes nuts, or some type of really strong bear market rally that will allow for more people to get into the market before the floor comes out, which seems to be the way things happen a lot. Long term, I am 100% bearish. There's so many things that have happened in our economy. In my Austrian economic type of mindset, we've got way too much debt. I don't believe the Fed is going to go very far. I may be wrong, and that's why if they do follow through, I do believe they'll follow through on their 75 basis point hike, and then they have like a 2-month hiatus after that in this month. If they continue, then they will drive this thing right into the ground. They've missed their opportunity when things were moving along well, not only last year, but a decade ago. All the stimulus, all of the spending, the COVID, all of these things have accumulated so much debt in the U.S. economy that this is going to be something spectacular either way that's going to end poorly. And I'll speak to that a little bit more at the end. Some of the economic and market measures that I've been watching, and this is kind of a regular, which is the AAII investor sentiment report. Now we've moved up a little bit to 22.8% bullish, 30.5% neutral, and 46.7% bearish, which is, if you might look at it the way of, this is an improvement over the last couple of weeks where it's been 19.4. These are really low numbers historically. Under 20%, maybe 8% or below are below 20% bullish numbers. And the last time we had the 21% sentiment, the floor dropped out from under the market, and we saw a huge drop at that point. Literally the next day after this report came out. So obviously then that led back to the sentiment going down, investor sentiment going down to 19.4%. It's been kind of in the doldrums since, except for this pop and after Monday of this week. Excuse me, after after this week, I think this number probably goes back down a little bit. But if we go off of the theory of what happened after 6/8, when we finally started to see maybe some relief and maybe a bear market rally, like I said, the floor dropped out underneath the market, and that was a pretty ugly time period. You can go back and look at how bad it was. I mean, we had gap down days that were it was really quite incredible. So the other thing that from a sentiment standpoint, hopefully you like my new cursor here. I made it bigger and also so red so people can see it. But the University of Michigan consumer sentiment is the lowest it has been in 10 years, 58.4, and you have to go back to the great financial crisis in 2008 to kind of get back to that number. I don't remember exactly what was happening back in 2011, other than that we were coming out of the crash. But regardless, the numbers getting down to record territory. Then you have to go back to 1980 with Paul Volcker, with his increases in the Fed rate back during that time period. So the message really is it's not pretty out there, and you can tell if you look at real personal consumption expenditures. People say, well, I don't think we're really in a recession. It'll be something shallow. But look at this. We had all this spending going on, obviously, in the first quarter of 2021 with the stimulus checks and all that type of thing. And now, the floor has been removed, and it's dropped out. So if you're not feeling the recession, you can look at some of these numbers and maybe see what other people are feeling. But I think by now most people are feeling the inflationary effects of what's going on, and they're making adjustments to the way that they live, which now leads us to the other big number, which is the gross domestic product, which in the first quarter was negative 1.6%, and now the latest estimate is a negative 1%. So now that's 2 quarters in a row. A technical recession, meaning the numbers are telling us that. Unfortunately, the Fed drives this economy out of the rearview mirror, and we have a government at this point that thinks spending money is a great and wonderful thing, and all that does is add to inflation, even though their modern monetary theory and their belief that it does the opposite is just, it's fantasy. It's bizarre to me that educated people could come up with something like that. But anyway, so we are in a technical recession. I've been saying that we're in a recession for a while. I reported last week that the estimates were for 0% this quarter. Now, a minus 1% technical recession. And, I guess if we're to look at the good news of this, is the Treasury is actually doing the job of the 10-year Treasury is actually doing the job of the Fed. And you can see that when we were on June 14th, we had a 10-year yield of almost 3.5%, and it's slowly but surely gapped down every week to now we're at 2.88%. I see some people calling by the end of the year that this number may be 1.5%. So this is representing the fact that we're seeing slowdowns, the spending slowdowns. We're seeing the inflation take the effect that it has on the economy, and this is gapping down now to back to levels where you know, and this is going to be my call, is that this will create some euphoria in the market when they start to see these rates come down. What will be the cherry on top will be if and when the Fed pivots and stops raising the federal funds rate. I'm not saying that they won't stop the 0.75% increase that they've already promised. They will do that, but like I said, they're looking at numbers in the rearview mirror, and these numbers are already representing well ahead of time when we look at personal consumption or personal expenditures dropping out. We're looking at the consumer sentiment dropping down. You know, they're going to be late again, and unfortunately, what this will do is drive really a terrible situation for not only the markets and the economy, but for individuals and families that are going to be affected by their actions and the actions of our federal government with all of its spending. So I still am developing my pendulum thesis that I talked about last week. Inflation is going up. It is starting to roll over as supply chain issues get corrected. What would kill it would be more spending, because that would just be more inflationary, and we really haven't put out some of the spending yet that we use, and now we're discovering all the fraud associated with some of the previous spending packages for COVID. But my belief still is that we're going to hit this sweet spot, this sense of euphoria as the 10-year Treasury backs off, and we start to see the economy tanking, but the unemployment rate, which is something the Fed will be tracking, will stay up there a little bit. But like I said, this will end too. All these job openings will disappear relatively quickly over I'm going to say the next 3 to 6 months, and then we'll be into a deflationary bust after that. So my expectation again is the inflation that we're seeing is starting to roll over. You're starting to see the 10-year Treasury yield back off. It's done a lot of the tightening already. It's reflecting what's happening in our economy now. And it's going to ultimately lead to the Fed having to back off because they're driving this thing into the ditch, and because they're always late, will be in the ditch by the time they start to realize it. But that there's going to be this sweet spot, this moment where people are feeling pretty good. Maybe things are oversold a bit with some of the interest rates and the Fed backing off. I believe all of these factors will ultimately lead to maybe lack of a better term, a strong bear market rally. It doesn't have to happen. You can't take it to the bank, but those are my expectations at this point. Then, once we've reached a sense of euphoria, and one of the people I've mentioned that I follow is David Hunter, and I think he does his is, just listening to some of his interviews, he's got a very good handle on what's happening, and he is right eventually. So my expectation is that we haven't seen the highs yet for the year, or we'll come back pretty close to what the highs have been in the markets, and then we'll have this deflationary bust. Because I pay attention to these investor sentiment surveys, it just isn't acting like you would see in a full capitulation, and it doesn't have enough people getting sucked up, into a rally to drop the floor out. And so that's kind of my pendulum theory, is this inflation. We're going to hit the sweet spot for a while. It's going to raise the markets, and then we'll have the deflationary bust. I can't imagine us getting away from that, and that's where we're talking about 80, potentially 90% reduction in the markets over a period of time. Not sure how long, but if I'm listening to David Hunter, probably 3 to 6 months, and then things will start to recover, and then the Fed will be and the government will be spending money like crazy, which will lead to the next major problem. And it's a cycle of things where we've got people tampering with an economy, trying to spend money on things that are the most ridiculous things I think I've ever witnessed in my life. But that's where we're at as a country. And with already $30 trillion in debt, the Fed can't go too far, or they risk having to pay a really high interest rate on the amount of money that this country has borrowed. So does this all play out the way the economists are saying? I think they're all pretty much pointing to some type of bust, and whether that's a market bust and not a deflationary bust, but regardless, a bust nonetheless. So we'll see how this plays out and go from there. So that's what I wanted to cover this week, and I want you to remember there is always a better way.